It's time for the Phil Ferguson Show.
This is Phil Ferguson, and you are listening to the cleverly titled The Phil Ferguson Show. We have a lot to cover today, and the big thing that you're going to enjoy is Acorns. I'm not talking about the nuts that come off of oak trees, but the investment app called Acorns. And when you spend a little money, you buy something, it rounds up, puts the money into your account, and then you get to invest with it. Is it a good deal? Is it going to make you money? We're going to find out a little later on. Before we get into that, we're going to have an HSA update. That is a health savings account. Talked about those a few episodes ago. Had some listeners write in and provide some information, so I have an update on that. We're also going to talk about the Volatility Index and whatever the heck that is. And then when we're done with all of the investing skeptically stuff and a little interlude, we'll go into our interview with Carl Richards. And he has written 2 books that apply to the kind of stuff that we talk about on this show. One is about how the brain works and how we think, and particularly how we think about investments. And another one is a quick and simple guide and some ideas on how to invest and why you should invest and what you're investing for, kind of the logic behind it and the rationale. Why are you investing? You have to keep that in focus. And we're going to do all of that stuff just today in this show, and I think we're episode 250, so enjoy. All right, folks, I got to do a little follow-up here on HSA, Health Savings Accounts. And the part of the beauty of this show is that I have the smartest listeners of any podcast. I'm convinced of this. And they are able to educate me and even correct me. So previously I had talked about HSAs, Health Savings Account, as being a mediocre to maybe a poor way to save for retirement, mostly because of my concerns over fees and expenses, etc. Well, I had several listeners write in and give me some information, specific information, and see, this is how you do it. When you hear something that you think is wrong, give me the very specific details, links, names, citations, and I can go and double check it and come back and do a thing like this. One of the companies that at least 2 people mentioned specifically is a company called Health Savings Associates. If you set up an HSA with them, there is minimal fees. To the best of my knowledge, it's $45 a year to have the account. Okay, well, I mean, you know, if you could open up an account directly with TD Ameritrade or Vanguard, you don't have that. But they also have the system in place where you can pull money out with a debit card or a credit card to pay your medical bills. So $45 a month, not a problem. If you then take some of that money and invest it, the ongoing expense ratio from them is 1/4 of 1%. So that's also called 25 basis points, 1/4 of 1%, 0.25%. So if you have maxed out your 401k, or if you have a really shitty 401k, if you have maxed out your IRAs or Roth IRAs, and you also have a high deductible health insurance plan, you may put, I think if it's a family, $6,500 into a health savings account. And if you don't spend it, or if you choose to not spend it, you may then invest it in mutual funds with Health Savings Associates. They even have Vanguard funds. So you can get the Vanguard index funds. And of course, any and all fees that Vanguard charges, you still have to pay those. And then you pay just the 0.25% to Health Savings Associates, which is good to know what it is because I don't expect them to open your account and manage it and all for free. And they're going to send me, I'm not too worried about it, but they're going to send me a list of all of their expenses, other expenses. Like, for example, if you lose your debit card, or if you pull money out and get a check, or if you get a paper statement, those things have additional fees. But if you just wanted to put money in there and invest it and look online and see how you're doing, it's actually a pretty darn good way to save several thousands of dollars extra a year. And it's the phrase that they use, because I did a little more research on this, is triple tax favorable. You get the tax deduction in the current year. So if you put $5,000 in, your income is reduced by $5,000 and you don't pay tax on that $5,000. You get the compound growth over time. And if you eventually take the money out for the purpose of paying medical bills, you don't even pay tax on the money when it comes out. So those are the three ways you get to avoid taxes. Sounding pretty sexy to me. So the next time it becomes an option for me to change health insurance, I may look at getting a high deductible and contacting these guys and getting an HSA set up. And it's to be another way to save some more money for retirement. So that's my little update / correction on health savings accounts. Do your homework, check out. And if you've got an old HSA from an old employer, or even if you have one and you're self-employed and the fees and expenses are killing you, do some research and maybe you can find a much cheaper way to do it. I had a reader ask me a question about volatility shares, and I thought it might be a fun thing to discuss just for a minute or two. There is the VIX, V-I-X, and then there's the inverse, the XIV. This is a way for you to bet on margin on the Chicago Board of Exchange on what you think the volatility of the U.S. stock market is going to be. And this is a very complicated and advanced way to lose a lot of money. One goes down if volatility is high, and the other one goes up if volatility is high. And so you're not betting on the market going up. You're betting on the change in prices of the market. So if the market goes down, you could win or lose, just depending on which one of these things that you buy. And I don't recommend either one of them, so I don't want to talk about it for too much, but it is interesting because the inverse one, when the market got really volatile, the Velocity Inverse Index collapsed, and it was in prices around 140, give or take, and now it's at $5.95. So it went from $140 a share to about $6 a share, and that was over a couple of days. So that has done so poorly that the distributor of that product, that hybrid thing, has decided that on the 28th of February, I think it's the 28th, the 20th of February, they're going to close that ETF. Actually, it's an ETN, which I'm not even going to get into the details of that, but there's all kinds of ways you can get really, really creative with your investing. And I don't like, particularly in this environment, creativity. I want to know what I'm owning. I want to know how it works. I don't really fully understand how these things work. And I'm in the biz. I mean, if this is something you want to do, great, but you're on your own. I'm not helping you. But I just thought you guys might find that interesting, that there was something that went from $140 to $6 a unit in just a couple of days. And that was because the market was going up and down $500,000, $600,000 or 1,000 points a day. So something to look out for. Just invest in what you know. Let's talk about Acorns, shall we? It's a little app you can put on your phone, and it's pretty easy to use, and you can hook it up to your credit card, debit card, bank account, those kinds of things. And when you buy stuff, it rounds up and puts that extra money into an investment portfolio for you. Sounds really easy. It actually probably is pretty easy. But is it a good thing to do? So I had to dig into this, and I've had a lot of listeners ask about Acorns, so I figured it's probably time for me to dig in and learn about it myself. I read a lot of articles about it. I read the actual documents from Acorns. I think it was about 46-page agreement. That's what you're agreeing to, 46 pages. I did not read every single word. Read some of it in depth and then skimmed a lot of it. I'm going to give you some information about that. And I also watched a lot of YouTube videos. And I think I've decided that after this experience, combined with my experience to attempt to learn about Bitcoins on YouTube, YouTube can be a really shitty way to learn about how investments work. It can cause a lot of confusion because you have people that know dick squat diddly about anything telling you how the world fucking works, and they don't get it. So that kind of irritated me. I had one YouTuber was talking about the aggressive portfolio. He thought he should be making 25% per year, but was only making a percent or two per month. 25% per year? Really? Where in the fuck does that number come from? 25% per year? That's just, again, it's just not how things work. You're not going to make 25% every year. Last year in the stock market, it went up about 22. International went up 28 to 30. An amazingly good year. You're not going to make 25% per year. If you have that expectation, you're going to be sadly mistaken. So really, don't watch YouTube to learn about investing, I guess. I have not really found much good content. There's the occasional thing. I know my show is on there, just audio only, just because. Another thing that is interesting, I watched a few people talk about Acorns on YouTube, and it turns out that virtually every one of them has a link or a connection or a way that you can go sign up and get Acorns. And I found out that if you do that, they get $5. So are they really giving you unbiased advice, or do they want to really promote Acorns so they can make $5? I know $5 is not a whole lot of money, but if you're getting by on some ads from YouTube and you can also make $5 here and there by promoting different products, maybe you can squirrel together a reasonable income, if not a full-time job for your side job making YouTube videos. So that bothers me. The other thing is I've watched a couple of YouTube videos where people were talking about the returns that they were making, and I think they were forgetting to add in the new money when they were calculating the percentages of what they were making, because I went and looked at the actual portfolios that Acorns builds, and I think there's only 5 or 6 of them that you can choose from. And they range anywhere from really conservative to moderately conservative to moderately aggressive to extremely aggressive. And they use different words, I think, but it's something like that. And inside of each one of those, they have a basket of different ETFs that they invest in. So if you're making really good returns, you have to keep in mind that you're adding money, which you should be doing. But these YouTubers apparently aren't taking that into account, because when the market goes up 22%, if you report to me that in 2017 you made 35%, you obviously did not include the new money that you're putting in, because I went and looked at the ETFs that they're using. There is no way your investment went up that much. You have to take out the money you're adding. The other thought I had before I even really got into the details of this is that if you think you're going to get to retirement by saving 20, 40, 50 cents at a time, I regret to inform you, you're fucking delusional. It's just not going to happen. The idea that, I guess, you could argue it's better than nothing. Maybe it is, maybe it isn't. We're going to dig into more of that, but it's just not going to work. If you're buying a $7.20 latte at Starbucks and you're excited that you're saving 80 cents because the program rounds up, what you need to do is not buy the fucking $7 latte and invest $8. That might add up to something. A pennies at a time, it's going to take a very long time to be significant. And if you're counting on this being any kind of reasonable portion of your retirement, you're going to be dissatisfied. Let's just go with that. Another thing about Acorns is that they do not offer IRAs or Roth IRAs. You will have what is called a non-qualified, which means it's not qualified for favorable tax treatment. A non-qualified account, also known as a taxable account, and you will have to pay taxes on the growth that you have. Not necessarily so bad, because if you're making money and you have to pay taxes, well, that means you're making money. So that's not so bad. But the portfolios automatically adjust based on whatever the algorithm Acorns creates. So that might be monthly. It might be yearly. I couldn't really find the details. They didn't want to give us too much information. But when they make adjustments, or if you switch from conservative to aggressive, and there's a big change in what you own, if that creates a tax consequence, and it likely will, you are going to pay the tax bill on that. So just keep that in mind. Another thing that Acorns has is, what do they call these? Like supporting vendors, where if you buy at certain places like Macy's, instead of just getting the pennies, you might get 1 or 2 or 5% match into your account. So if you spend $100 at Macy's, Macy's might put $5 into your Acorns account for you. This kind of goes back to my earlier thought that if part of your retirement strategy is saving pennies at a time, nickels and dimes and quarters at a time, you should not be shopping at Macy's. I'm sorry, it's expensive to go into a department store and buy things. You should put that money into your account. Instead of worrying about the 5% match, you could put 100% of the money you didn't spend into your retirement account. And it worries me, like a lot of programs like this, they're geared towards getting you to be a consumer and not a saver. The whole idea of Acorns is that you're going to save automatically when you go spend. So go spend some more. I think that runs a risk of being counterproductive. Another fact about Acorns, if you have less than $5,000, it is $1 a month for this program, for them to manage your money. Now, clearly, $1 is not a whole lot of money. But if you only have $100 in your Acorns account, you are effectively paying a 12% fee for them to manage your money. That seems like a lot of money to me. If all you can squirrel together is $100 and you have to pay 12% for them to manage it, you're going to lose money. I mean, even in the aggressive portfolio, if you're 100% in stocks, theoretically the average year, and there never is an average year, but on average you're going to make about 10%. Well, if you're paying 12% in fees, you'll lose money. If you're in one of the more conservative portfolios making something like 3 or 4%, you're going to make 3 or 4 and pay 12. So $100 or less, this is comically a bad idea. Even $3 or $4 or $500, I mean, at $500 instead of, let's do $600. Instead of paying 12%, you're paying 2%, which again is not horrible. But if you're in the conservative portfolio making 3 and you're paying 2% every year, it's going to take a long, long time for you to make anything because you're clearing 1% per year. So that really bothers me. And once you do get a little bit of money, I mean, if you go to $1,000, you can open up an account at Vanguard. You can open up an IRA at Vanguard and have no taxes, have the incredibly low expense ratio of Vanguard index funds, and with $1,000, you can put money into a target date fund. And I can hear it already. Some of you are going to be going, but Phil, you said target date funds are bad. No, I have not. I say target date funds are suboptimal. There is often a better way to invest your money than a target date fund. However, in some occasions, it might be, for example, in your 401k, the best fund for you to invest in. It might be, if you only have $1,000 freaking dollars, the best thing for you to invest in because you can't afford to go buy 10 or 20 stocks. You can't afford to meet the $3,000 or $10,000 minimum for the more efficient funds. You only have $1,000. It sucks when you don't have money. Your choices are incredibly limited, but I would rather you saved up enough to get to $1,000 and put it into an IRA and have it set up at Vanguard and have incredibly low expense ratios, and you won't pay $12 a year. You won't even pay once you get over $5,000 at Acorns, the expense ratio is 1/4 of 1% or 0.25, also called 25 basis points, which is not bad. That's not a whole lot of money. That's 1/4 of the rate Phil would charge you, unless you have larger and larger accounts because the rates go down. But you're not getting a whole lot for that 25 basis points or 1/4 of a percent. They have 5 portfolios. You pick the one that you want, and that's it. There's no human interaction. There's no really personal advice. There's no ongoing guidance or management of the account in any meaningful way. So if you only have a couple $100, the fees are counterproductive. If you have $1,000 or more, I think you're better off putting your money at Vanguard. And you might say, but Phil, this is so easy. It's so freaking easy to open an account at Vanguard. God, I wish these guys paid me a commission. You just go to Vanguard.com and open an account, open an IRA. You start saving money. You can't invest in anything until you get 1,000, but at least you're not losing anything. And when you get 1,000, pick a target date fund close to your retirement or even further out if you want to be more aggressive. And that way you can start investing. And you say, well, I want to tie it to my bank. You can tie your Vanguard account to your bank. It's really easy. Other things about Acorns that maybe you might see as a problem. Now, maybe I misunderstood this, but I don't think that I did. I found that when you want to take your money out, it can take days, weeks, or even longer. And there is a one-time fee of $50 per ETF. Most of the portfolios that they have you pick from, the 5 or 6 of them that exist, each has 5 or 6 ETFs in it. If it has 5 ETFs and you want to sell your money, you want to pull it out of Acorns, and let's say you have $1,000, if you have 5 different ETFs, you're going to pay $250 to get your money out. That's right. You're going to lose 25% of your money. So it could take you months to years to save up the money. And then when you realize you could go somewhere and be more efficient than Acorns, you might have to pay $250. If you want paper statements, they're $10 per month. If you want paper confirmations of purchases, they're $15 a month. So again, if you have only a couple $100, this is a terrible, terrible idea. I'm really underwhelmed. Other things to know is that you are investing with Acorns advisors, and Acorns advisors buys the ETFs through another company that they own, or the same ownership, called Acorns Securities, LLC. And I only found this out by reading that 46-page document. I had to dig and dig and dig on their website till I finally found it. The other thing that was really odd to me is that they talk about owning fractions of an ETF. And I don't know that the ETFs that they're buying are available in fractions of an ETF. I mean, they'll show that you own 0.4613725 units of an ETF. And I'm thinking to myself, that's not how ETFs work. Usually they're sold in absolute minimum of 1 unit apiece. They don't sell in fractions. It's not Bitcoins, people. These are ETFs. And so how do they do that? And so I actually sent an email to Acorns, and I'm going to read it to you here. It says, this is what I wrote to Acorns. Hello, if I invest $1,000 with Acorns and you buy ETFs for me, who actually owns the ETF? Will the shares have my name on them, or are they held by Acorns and I own a small part of your portfolio? Now, the nice thing here is Acorns actually responded. So I guess you can get some service from somebody. Acorns responded back, which is very nice. Thank you, Acorns. And to make sure that I do not misinterpret what they sent me, I'm going to read it in full, what they sent back. Hi, Phil. That is a great question. You do own the fractional shares within your portfolio. However, they are held under our name, Acorns Investing. If you have additional questions, feel free to contact me directly by replying to this email. Thank you, Sabrina. So Sabrina, thank you for writing that email. I do appreciate that. And so what this means is that if you open the account, it has the account from Acorns, which is actually run by Acorns Investments or whatever the name was. I forgot just a second ago. The holdings are not in your name. So you can't move your ETF ownership from Acorns to Vanguard or to Fidelity or to TD Ameritrade. You have to cash out, which is probably why they have that $50 per ETF fee to cash you out, because they've got to do the paperwork and the processing to give you your money back. It also concerns me that if anything happens to Acorns Investments as a company and they go bankrupt, how do you get your money? It's not in your name. It's only kind of sort of in your name because Acorns Investments says it's in your name. So when you invest with a broker dealer or a mutual fund company, those investments are held in your name. Let's say, if Vanguard goes broke, for example, Vanguard doesn't actually even hold your money. The mutual fund holds your money, and that's managed by a separate trust, an outside company, an outside entity that holds the money. And if Vanguard itself went bankrupt, the index funds and all the stocks within them are still owned by you and have your name on them. It might be difficult and time-consuming to get your money, but it's still owned and it's still in your name. And it also has insurances and guarantees from the government to make sure that you don't lose your money. Now, if you're invested in the stock market and it goes down 50%, you are going to lose 50%, but you're not going to lose money because Vanguard itself goes bankrupt. What happens if Acorns goes bankrupt? I don't know. That was very concerning. So the fact that your advisor is your broker is not necessarily a problem. It's something I like to steer away from, but that's the case with Acorns. So some of the basics: $1 per month, 0.25% over $5,000, but you can do this with a target date fund without paying the 0.25% and get basically the same thing. You can't get an IRA. You can't get a Roth IRA. And quite frankly, if you're saving pennies a month, it's never going to happen anyway. The other thing that I almost forgot to mention, I kind of thought when we talked about that coffee or the latte earlier, if I buy something for $7.20, Acorns rounds it up to $8 and puts 80 cents into my account. Well, it doesn't actually quite work that way. And maybe that was me misunderstanding the advertising. They don't round up your credit card charge from $7.20 to $8. In that case, Starbucks still charges you $7.20 and the transaction goes through as normal. What happens is Acorns sets aside 80 cents, wink, wink, nudge, nudge, for you, but they don't actually collect it from you. So they have a little account that has a running total of all these fractional dollars that you're saving, air quotes, saving, until it gets to be $5 or larger. And when it's $5 or larger, they do an ACH, an automated clearinghouse transaction, against your account of choice. And so probably a debit card or a checking account. I don't know, and this is my ignorance, if you can do an ACH against a credit card. But if they can, then that's how they'll do it. But they'll collect the money from you, from either your checking or savings account or your debit card. So if you want $5 to come out of your account, you could set that up as an automatic payment to any other place. You don't have to do it at Acorns. It's very clever. It's very slick. But if I'm going to put $5 aside somewhere, you can do that anywhere. You can set that up with any account that you can set up at a brokerage firm. So you don't need Acorns. So they're not really rounding up your transactions per se, but they keep an invisible tally going. I guess it's visible. You can see it, but they don't actually collect money from you until it gets to be $5. And then they move the money over. So I don't know if that really matters, but that's kind of how it works. Some thoughts on Acorns. And if you haven't figured out by now, I'm going to give this 2 thumbs down. I don't recommend it. If you have only a couple of dollars, the fees are expensive. The service is options are limited. The people who are promoting this don't understand how it works. And once you get to $1,000, you could buy a target date fund and get the broad diversification without paying 1/4% by simply getting a target date fund at Vanguard. So that's some of my thoughts on Acorns. If you disagree, or if you've had great success with it, feel free to send me an email, phil@polarisfinancialplanning.com, and we'll take a break here from our Investing Skeptically segment, and we'll come back and talk to Carl Richards.
He loves you and he needs money. He always needs money. He's all powerful, all perfect, all knowing, and all wise. Somehow just can't handle money. Religion takes in billions of dollars. They pay no taxes, and they always need a little more. Now, you talk about a good bullshit story. Holy shit.
All right, everybody, welcome back. This, of course, is Phil Ferguson, and you are listening to the cleverly titled The Phil Ferguson Show. With me today, I have Carl Richards. How are you, sir?
I'm great, Phil. Super good.
Well, that is delightful. Now, I understand you have been in the investment business, an advisor for a few years. Can you give us a little bit of your technical background?
Oh, yeah. So technical background. I mean, I got into the industry quite by accident. Ended up getting my degree in finance, and then was an advisor for, we're going on. I've been in the industry, speaking broadly, in the financial services industry for 22 years now, and had jobs at a range of sort of wealth management and institutional, private wealth management, financial advisor jobs at a range of firms, big firms that everybody would recognize, and then went out and started my own independent advice firm. And then 7 or 8 years ago, sold that, and have just been writing and speaking and training and coaching in the industry for the last 7 or 8 years.
Well, it's stunning to me how similar some of that is to me, because I am in my 22nd year of doing this. And I also got into it accidentally, which I won't bore you with or the listeners yet again. But you have done something that I have not done. You have written a couple of books, and I like that they are not heavy in math, so almost anyone can listen to them and enjoy them. I listened to both of them on audiobook because I really don't have the attention span to read books, but I can listen to them while I'm driving. Listen to both of those, enjoyed them very much, but you did kind of piss me off.
Good. Awesome. Well, that sounds like we'll have something to talk about then.
Well, we'll have something to talk about. I mean that mostly tongue-in-cheek. I do have one specific thing that we can get into later, but the tongue-in-cheek thing, the reason I'm upset is because both of these are kind of the book that I thought I might someday write. And now I'm kind of thinking, what is the fucking point? Because you already did it. So
yeah, it's funny. That's actually one of the questions I use on new projects, because I have, and I used to get mad about it. And I still do sometimes. I still read a book and I'm like, oh, this is the exact book. Yeah. Not that it would have been. I don't ever make an assumption that it would have been nearly as good or whatever as the book that somebody else wrote. But if I had the talent, I would have written that book, is what I end up saying. And I'm not saying you should have said that about me. I'm saying that's what I say. And I used to get kind of mad about it. And now I'm finding myself more kind of relieved when I find the book, because sometimes we don't have to veer too far into this sort of the process of creating content, but sometimes I get an idea and it sort of bugs me. Like the idea itself is saying, hey man, I really want to get out into the world and I've chosen you and then I find a book that expresses the idea the way I would, and I'm like, oh, good, I can check that off the list, right?
There you go.
If somebody else wrote the book. So I guess what I'm saying is maybe you could view it that way. It's a relief. You don't have to do it. It's already done.
It is, and I listened to both of them. And for the listeners, in case you haven't, I don't know, heard my regular list of books, I just only have 3. I'm toying with adding one of these or either of these as an alternate or a 4th book. But they're both by Carl Richards, again, my guest. The older one, if I have this order correctly, is the one-page financial. Oh my gosh, it just started playing. Financial Plan, a smart way to be smart about, I'm assuming it says your investments, your money. The one-page financial plan. So yeah, that was well done, Phil. Good job. And the second one is the Behavior Gap, simple ways to stop doing dumb things with your, oh my God, it doesn't give me enough, with your money. Oh, same last word.
Yeah. I'd start with the Behavior Gap was actually the first one. And that's probably where I would start. The one-page plan, I love, just between you and I don't tell anyone this, but I love, and I'm joking about that, but the first 95 pages are my absolute favorite part of that book. And I think that's really valuable. In fact, that's where most of the good stuff is. But the Behavior Gap, I love that. Well, that was the first book.
And it's one of those things, and, I've had people with different opinions on, but it's also kind of nice to have reinforcing opinions. That we all like that as humans. Yeah. But some of the fun things, it's nice for my listeners to hear from a different person, maybe a different spin, and maybe it clicks in where they've heard me say it before, but it doesn't. And so one of the things that you talked about, and because I just slammed them both down back to back, I will not be able to tell you which book it was from. But
no worries.
One of the things that you said that I find hysterical is the same thing, is that you'll be talking to somebody and they say, well, just give me the plan. What should I do? Go.
Mm-hmm. Yeah.
And you don't find that comforting.
No, it's funny. I think that was in the one-page plan. And we just have to remember, I think, that we're all so cognitively overloaded. You come home from work and, if you're like most American families, you're running around with kids going to different things or working a second job or, whatever it is. There's not a lot of space to think about things. And then you add on top of it that this money stuff, we typically think it involves math, and, that math isn't necessarily anybody's favorite subject. And then on top of that, it often involves an endless, what feels like an endless set of options. And we know from research that endless options don't do the brain good. We tend to just freeze and do nothing because we can't decide between all those options. So when you add all that, it's a really potent sort of cocktail for doing nothing or choosing just to ignore it. And I think that's what most people do, because you just really want to be told. It's like going to the doctor. I don't have time for him or her to tell me, here's 4 different possible treatment plans and 4 different drugs you pick. And that's just 4, let alone the 5,000 mutual funds to pick from. So I just want, when I go to the doctor, I want the doctor to listen carefully enough to me to thoroughly diagnose and then tell me what to do. And that's, I think, the best real financial advisors in the world. That's what they do. They listen carefully enough and then they tell you what to do.
Well, I have said on occasion that I get paid to tell stories and to talk to people. And the financial investment stuff is just something I happen to be able to do, but without being able to communicate with people and learn about them and what they want, it kind of doesn't really make much sense to me. But another topic that I cover a lot and is in your book is, of course, you love the idea of buying more stocks after they've gone up a whole lot, right?
Precisely. Yeah. Why not buy high and sell low? That's a great idea.
The example I use is very similar to yours. I tell someone they go into a store and they see a sweater for $100 and they contemplate it and think about it. And they said, I'll come back. And a year later, the sweater is now $300. So, of course, they buy it. And everyone thinks that's comically ridiculous. But when we look at a stock that's gone up 2 times or 3 times or 10 times, as humans, we get excited and we want to own that. Walk me through the psychology of that a little bit, if you can.
Yeah, for sure. It's, we're really kind of coy about it, and it's a little sarcastic, and we, buying high and selling low, that's dumb. And, but when you understand the sort of genetics, it's almost a genetic issue, right? We are hardwired, and this has been an important trait for our survival as a species. It doesn't translate particularly well to investing, but we're hardwired to get more of things that give us either security or pleasure. That we're genetically hardwired, and we're hardwired to get away as fast as we can from things that cause us pain.
Well, I think for example, back with the .com thing in a couple of years after that, 2002, what did people do after the market had fallen so much?
Yeah, I mean that's sort of a classic. At this point, it feels like a classic example, right?
Yeah.
And we could use 2009 as well. Which is just, you understand. We all, I think, as humans, can understand why, when for some reason we've equated market going down, and I know why the news, your neighbors, the society in general does a very good job of market going down equals scary.
Right.
And so you hear all that, it makes sense that you're like, I'm out, right? But when you step back just a minute, and we all sort of get the benefit of that maybe a year later, you step back and go, God, that just doesn't make sense, right? So yeah, that's what people do. They say, this is scary, get me out. And for some reason they see, well, not for some reason, normal, rational human beings think, this is scary, get me out. The only way to relieve the pain is for me to go to cash, right? To sell out of this beautifully designed portfolio that I was going to hold for 20 years, sell out, right?
Well, and just make sure I'm clear for the listeners, what happened in 2002 and 2009, as you pointed out, is that investors, the average Joe Schmo investor, pulled money out of stocks in particular at record-setting numbers after the market had fallen. And that's not a good strategy long-term, right?
No, yeah. I mean, we've all been taught, right? You buy low and sell high, not the opposite. But, Phil, one thing that I think is important that, I think is, and we're seeing, at the time we're recording this, the markets have been scary for the first time in a long time, right?
Couple of years.
So we're seeing this. We're seeing this again, where one of the things I think we need to be careful of is the sort of smugness that seems to be pervasive in the financial advisor, financial planner, financial journalist industry, where we're all sort of like, hey, look at these dumb people and how they behave. And I think it's really important that we understand, especially for your listeners, like, you understand, like, it makes sense from a genetic sort of standpoint why we humans behave that way. I get scared when I read news during times like that, right? Like, I was scared in 2009. Now, getting some help so I don't act on that fear, that's sort of the discussion we're having, but I just wanted to insert this little piece in here of just sort of empathetic understanding of, like, it turns out the reason you behave that way, which in hindsight looks really dumb, right? The reason for that dumb behavior of us humans is because we're human, right? The fact that you feel that way is because you're human. Right. And that instinctual behavior probably kept you alive, kept us alive as a species, right? But it's just now we've got to start the little journey. Once we understand one another, we give each other hugs, everybody's okay. We can now start the little journey of going, okay, that's clearly behavior that's not in our best interest. How do we solve for that?
Well, it's one of the things that I've covered this before, and I remember talking to either a client or a listener of the show, and they said, so if the market falls 37, 40% plus or whatever it did in 2008, then I just shouldn't be sad. And I said, oh no, be sad. Own the emotion. You can't change how you feel about something. When you open your statement, especially if you have a big portfolio, any portfolio, I guess, you open up your portfolio and you're down 10, 20, 40%, there's no way to not be upset about that. The trick is to not panic and do something you're going to regret later.
Yeah, that's true. It is interesting, right? Like, I think that's generally, and I would even say like maybe 80-90% of the population. That's true. It's so fascinating to me though, every once in a while to run into the people that have got that switch flipped, where they're like, wait, I'm not planning on using this money for so long. This is just another opportunity for me to buy cheaper.
That's
for
right.
me to accumulate more shares. Like, I've got a friend who runs a big mutual fund company. His first name is John, and most of your listeners would recognize that mutual fund company. And we were having lunch once, and he was like, and it's not the John you're thinking of. It's not John Bogle. We were having lunch once, and he was telling me about in 2000. This must have been 2002, not 2009. 2002, he and his wife. Now, these are people worth more money than I'll ever have. And he and his wife stopped buying books and started going to the library because they wanted to find every extra cent they could to buy more shares in a down market. They were so giddy about it. Right now, that's a very unusual. Like, Warren Buffett has that switch. And I think we can train ourselves over time to be like, but for most of us, you're exactly right. Like, just be okay with like, oh my gosh, that's scary. And then put a big pause between the stimulus of being scared and the normal action of getting out of the market, put a big space there and go, okay, what do I do here? I go on a walk. I call my advisor. I talk to my brother-in-law, I have my father-in-law throw a tennis ball at me. Like, whatever it is you do to keep yourself from not acting in a way that will be harmful to your own best interests.
Well, I always make the analogy of the famous Aesop's fable, the tortoise and the hare. You behave like the turtle. Just add money, add money, add money, add money. But I do get scared. I actually just a few days ago had one of my clients say, should I get a second mortgage on my house to invest now that the market is down? And I go, down? This is not down. I mean, we're back to where we were January 1st. So relax, just save what you can. But yeah, it's an interesting thing. Now I have a note here and I'm hoping this jogs your memory because I don't remember why I typed it. Because when I was listening to the audiobooks, I typed this. So fingers crossed, we're going to try this. But my question is, how far away is the past? What does that mean to you?
Yeah. So we have this tendency, and it's a very normal human tendency, well studied, well researched, to project the recent past indefinitely into the future, right? So if the economy's been bad, we start saying things, it's been bad for a certain period of time. We start saying things like, it'll always be bad, and I will never buy stocks again, or real estate always goes up, those sorts of things, real estate being the positive example. Real estate's done well. Real estate always goes up. I'm living in New Zealand, and New Zealand real estate market has been on fire for a long time. I mean, positively. And, I'm watching, I lived in Vegas too. And I watched people go from real estate never goes up to literally like our house was worth 50% of what it was 6 months in a 6 month period, like crazy. And I'm here now having that memory in my head. I'm here in New Zealand listening to people say real estate is the best investment ever. And I'm hearing almost the exact same words come out of almost the exact same type of people out of their mouths as I heard in Vegas. And I'm sitting back thinking that, well, I hope they're right. But, but your question is, we project the recent past indefinitely into the future. And the definition of recent past seems to have compressed a bit in just my working life. So the last 20 years, I bet if I had asked my grandfather what the recent past was, he would have a longer view. Now with sort of Twitter and Instagram and Facebook and the news cycle so much, it's almost as if like what's gone on the last 2 days, we're starting to say, our democracy is over or not, depending on your view. Like the markets will never be unvolatile again. Wait, it's only been a week, So I think that's called confirmation bias, just looking, it's called recency bias, looking at the recent past, projecting the future. Let me give you a practical example. Let's say you've always gotten a bonus in January or February. So you always get sort of your bonus from the prior year in January, February, and it's happened 2 years in a row. So by always, we mean 2 years in a row. And then you are trying to make a decision on buying a new house, and you're just a little short. But you think, oh, yeah, that's right. I always get that bonus. And with that bonus, you're going to be fine. And you make your purchase decision based on that happening, and then it doesn't happen, right? So it's more than just the stock market, the economy. It's even personal finance decisions. Instead of saying, hey, you know what, why don't we treat that bonus as what it is, a bonus? And if it happens 3 or 4 years and we save, why don't we, So the solution to this problem, recency bias, is broaden your definition of the recent past. Like go back a little further and go, oh yeah, that's right. There was a time when real estate in New Zealand got crushed. Oh yeah, there was a time when the stock market was volatile. Oh, that might happen again, right? And then make your plans accordingly.
Well, one of the other things you had was the overconfidence test. And I don't know if you remember all the parts to that. Is that something you can do from memory off the top of your head?
Yeah. And you're talking about the overconfidence conversation, not the overnight test.
The overconfidence.
Remember?
Like, what if I'm right? What if I'm wrong?
Yeah, yep. Totally. Just wanted to make sure. So this is a typical problem. Like, I don't know overconfidence is so tricky because overconfidence is what you get when an expert behaves exactly like you would expect an expert to behave, right? Like it's really hard to especially, and I'm not making a sexist comment here, the research backs this up, especially among men. It's really hard to deal with overconfidence. So the overconfidence conversation, one way to talk with maybe a spouse or a partner or a friend who's just convinced, like let's just stick with our theme here, New Zealand real estate. I'm gonna double down on New Zealand real estate because I'm going to get out of my retirement account. I'm going to borrow some extra money because I'm just so confident that real estate will continue to go up in New Zealand. This is a faraway example, but it's fun.
Yeah.
And so the conversation you could have is just simply, okay, question number one. There's 3 questions. Question number one, what would happen? How would your life change if you were right? Now, most of us aren't talking about betting the entire farm on something. So the answer every time I've had this conversation hundreds of times. I don't know how many hundreds, but hundreds of times. And I've almost every time the answer, because I'm still dealing with semi-reasonable people. They're not talking about taking 100% of their money and throwing it in Bitcoin or something. So I'm gonna buy another house in New Zealand. The answer would be, if I'm right and the market goes up, even if the market doubles, like my life would be marginally better financially. Like maybe it means I take an extra trip. Maybe it means I retire a couple years early. Like, I don't know, but it's not life changing, but it would be marginally better. And question number 2, what would happen if you were wrong? And often the answer to that question is, oh my gosh, like, what do you mean if I was wrong? And they're like, okay, let's just paint a picture. You're wrong. And instead of this thing doubling that you're about to buy, let's say it gets cut in half. You lose 50% of your money. Or in some cases, like a crazy Bitcoin analogy, you could lose 100% of your money. How would your life be different? And often the answer to that question is, oh, geez, right? Like I'd be working an extra 5 years, or we'd have to eliminate the kids' education money, or, like often the answer is that would be a major impact. And then the third question, which you have to ask gently, unless you want to be drill sergeant style, that works too. But especially if you're doing with a spouse or partner, just gently just say, hey, well, here's the third question. Have you ever been wrong before? So you can make that a little more gentle, soften it up a bit by just saying, hey, would you consider the possibility that you could be wrong? But yeah, I have found every time I take people through that, it opens them up to the opportunity of just exploring like, yeah, I hadn't thought of that. Pointing out the potential havoc that things going sideways would wreak.
It's interesting that you brought up Bitcoin. You and I didn't talk about Bitcoin before, did we, or cryptocurrencies?
Nope.
Okay.
I have a general rule not to talk with anybody about it.
I think I have that same rule. But back in Thanksgiving, some people started harassing me and telling me that basically I was failing to be a fiduciary if I didn't put 10% of my clients' money in Bitcoin. And so I really researched it, and unbeknownst to you, but my listeners know, I did 2 one-hour-long episodes right before Christmas, 2 or 3 days after the peak price, explaining why it can't possibly work. It's not even plausible. And the number of listens, it just has skyrocketed to crazy levels as people have shared that around. So I thought it was kind of funny that you, on your own, went to Bitcoin, and I did not lead you there. Talk about this, another idea in investing, the greater fool. Speaking of Bitcoin, what is the greater fool? Walk us through that, and maybe in getting back to stocks in relationship to the infamous .com.
Sure. Yeah. So greater fool theory is just simply the idea that you're willing to do something stupid just because somebody else might be stupider. So the way to sort of catch yourself in, falling sort of victim to the greater fool theory would just simply be like, this doesn't make, if you're relying on prices going higher and somebody else, so if you find yourself going, man, this just doesn't make much sense, but I can get in and somebody else will buy it from me later, like it'll go up 20%, you're essentially relying on somebody to be a greater fool than you. Obviously that's a bad idea. Like there should be some other, you should be making these investment decisions based on evidence and research, not stories and friends. And the greater fool theory, when you fall prey to that, is exactly that. Like, oh, this doesn't make any sense. But I mean, when we got in trouble in Las Vegas real estate, I really think it was a function of the recency bias and me falling prey to the greater fool theory of just thinking this makes no sense, but man, I got to get on this train because everybody else is, and I can sell it later. So
that's right.
That's the greater fool theory.
Well, it's interesting because I have had a few clients now hit me up in a few parts of the United States where real estate is hot again, and it's going up like it did in 2005, 2006, 2007. And they'll say things to me like, I have to buy now because if I wait a year or two, I won't be able to afford it because they're going up so fast. And I was like, do you hear yourself? Because I've heard this song before. No guarantees that it will be the same as before, but it does scare the crap out of me when people start doing that. Or like when someone, and I had this back in the late 90s, when people would come to me and go, I'm sick and tired of people making easy money in the stock market, 30% a year. Fine, I'm going to finally get in.
Yeah, look, and again, we have to be empathetic of like, I understand where that feeling comes from. And especially if you're, like just on the edge of being able to afford a house, that like, and any of us can be on the edge. I don't mean like first time home. It could be like, oh, we could get into this new neighborhood we really love, or we could move to this new city that we really love, whatever it is. You're just like, oh, and you almost, it's almost like there's a train leaving the station and you're sort of trying to decide if you should jump on or not. And then the longer you wait, here's the interesting piece about this. The longer you resist, you should either fall prey to the greater fool theory early or not at all.
Right.
Because the longer you resist, the more trouble you get in. Like if you're going to capitulate and decide to join, do it early, because at least you'll enjoy part of the journey. But it's those people who are stubborn, like hold on to their beliefs. And stubborn, I mean, in this case, I'm talking about a good thing. They're like, no, I'm not going to buy into this .com craze. I'm not going to buy into this Bitcoin craze. I'm not going to buy into this real estate craze. I'm not going to. Okay, fine. Those are the people that get hurt the most. So, the the better approach, particularly on any of these things, is just to say, okay, what's the buying something because you're either going to miss out or because it's hot, right? Like either one of those things is sort of like should be a warning sign that you should just back up and go, wait, what's the more fundamental reasons? Using house, for example, whatever sort of job, I don't even know what job this would be in these days, but let's say a tenured professor, right? Because that's the only example I can think of where you literally going to have a job for 20 or 30 years.
Right.
You've got tenure at Stanford and you're like, we're going to live here for, and I'm just going to use the number 10 plus years. We're going to live here for 10 plus years. Well, at that point, and then the second decision is, can we afford it? Okay, we can afford it. If you can afford it and you're going to be there 10 plus years, well, then that's a better way to make a decision about buying a house than, I'm not going to be able to afford it if I don't get in now.
Well, I think this leads me to an idea I was thinking about earlier, and I want to kind of see what your thoughts are on it. What do you think of the phrase when someone says, okay, I'll try the stock market? What does that invoke in your brain?
Yeah, it's just not that is just a recipe for disaster is what it is. That's like trying skydiving.
Okay.
Like you don't, one of the first sport that popped into mind is I whitewater kayaked for a while and for a couple of years and loved it. It was maybe one of my favorite sports of all time, like super fun. And then I slowed down and I stopped going and I was just going a couple times a year. And then I got in trouble. I got pinned upside down in a river and got out. And when I got out, I was like, that's it.
I'm done.
Like, you don't sort of try, you don't dabble. But the stock market doesn't require a commitment like that. It just requires you to say, I'm going to buy something. That's like saying, I'm going to try planting an oak tree and then, like 3 months from now, I'll pull it up and see how the roots are doing. You don't do that.
Okay. So definitely the buy and hold long-term mentality.
Yeah, I wish there was a better answer. There's no, and I'm not necessarily saying what you buy and hold, but you buy good things. Preferably you buy good things when they're cheap and you hold on to them for a very long time. I don't know any better answer than that. I've read all the research. I've read every book on it. Everybody else who's told me fancy, tricky schemes to do something different, I haven't had much success. So,
well, the famous poet that I always quote is, oh gosh, I'm going to do it wrong here, but let's see. It's something like this: either do or do not. There is no try. Yeah,
isn't that Yoda?
Yeah, it is. Very good.
Yeah.
So I know when I'm talking to a prospective client and they're like, okay, you talked me into it. Let's try the stock market. My reaction is, whoa. I don't know what I talked you into, but now you're scaring the shit out of me. We need to stop and do that. Another topic, fees and expense ratios. Do fees matter? I mean, if I get a mutual fund that's 2.5% per year, is that okay? Walk me through that.
Yeah, this is just the cold, hard reality of math. And it's pretty, it's like the law of gravity. You can't really fight it. Fees matter a ton. They don't seem like much at the beginning, but they matter even more as you compound them out. So if you think about, you've got an investment that does, and they matter. They matter even more depending on sort of what rates of return you're talking about. But let's say you've got a historical rate of return of 8% and you pay 1% in fees. That means you keep 7. If you got a historical rate, the same rate of return of 8% and you pay 2.5% in fees, you only keep 5.5%. You take 7 versus 6.5. No, 5.5%. You take 7% and compound that out versus 5.5%. 30 years later, the difference could be as much as 30 or 40% difference in your terminal in the amount of money you have in the end. So yeah, they matter a ton.
I've got 2 more topics if you have more time, because I know we're running a little late.
Sure. Yeah. Yep.
I'll start with one where we'll probably agree on, and then I'm going to go to the one I promised you from the very beginning of our conversation, where we disagreed, maybe a little bit. It's kind of a fine line. And think of it, if you can, because I don't know if you're permanently in New Zealand. Do you live there now?
Yeah, we live here. We've been here a year and a half. We'll probably stay another 2 years.
Okay, so think in terms of the U.S., because many of my listeners in the U.S., and I try to focus on that, although podcast goes out anywhere in the world, U.S. interest rates are still, especially for long-term rates, at historic lows. What do you think of buying a whole bunch of long-term bonds, high-quality government long-term bonds right now?
Yeah, so you just need to understand that the fixed income, if you're talking about portfolio design, which is what most 99% of the public should be thinking about, not buying individual asset classes and trading them or whatever. The role that bonds play is to be a ballast in the portfolio, right? They're to provide you with the stability to allow the portion of your portfolio that's in things that grow, called stocks or equities, to do their job, right? So whether you have 20% in stocks or 80% in stocks, the other piece of the portfolio should be stable. I think of it as like stocks wiggle a whole bunch and bonds don't wiggle a whole. At least bonds' their job is to not wiggle a whole bunch. Where we get in trouble is when we confuse those, and you start thinking, well, I can't handle only getting 2.5% on my bonds. I'm going to go out. The only choice you have, if you can't handle buying short to intermediate term bonds so that they'll be stable and safe for you, so your stocks can do their thing and you won't emotionally get crushed. The only choice you have is to go out in what we refer to as duration, but out in maturity to buy long-term bonds, or down in credit quality. So in the example you gave, state safe, quote unquote, in air quotes, safe government bonds. When you say safe, what you mean is they won't default, and we could have a whole long debate about that, but let's just assume
yes,
that history is our guide and they won't default. But what is going to happen is people just need to understand interest rates. You own a bond, you've got a fixed interest rate. As interest rates move up, so let's say you buy your bond and you've got a 3.5% or a 4% coupon on your bond, and let's say that same bond a year from now, 3 years from now, 10 years from now, whatever, somebody could go out and buy the same bond now and you've got 4% and they could make 6.5%. Well, what's going to happen to the value of you're still going to get your 4.5%. Like if you hold that thing till it matures, no worries. But you are going to open your statement one day and go, oh my gosh, my bonds are down 10 or 20%. And again, if you hold on to them, no problem. But if you don't, and again, now we're back to the function. Bonds are there to provide stability for the portfolio, and now your bond portfolio is down 10 or 15%. That's exactly the opposite of what you want.
Excellent.
So short answer is, please don't buy long-term bonds right now. Bad idea.
Well, it's one of those things that I have been hitting constantly, and I had to admit at the very end of the year that the Vanguard long-term U.S. Treasury Fund was up 8% for 2017, which really shocked me. But it's now down 6% in the last 6 weeks. So that's the volatility that it defeats the purpose. So I before I told you what I thought, I wanted to hear what you thought. And maybe my listeners hear you say it and it clicks in a little bit better or a different angle than me. So I allow for that possibility. Mm-hmm. The one thing that maybe we disagree on, and we can have a good talk, and it's a very popular topic with my listeners, talking about putting money down on a house, prepaying a home. What I have been doing for the majority of my life, not when interest rates were 7, 8% for a home loan, but since they've been 4% or below, I have put down the smallest amount possible, intentionally paid PMI, and I make the minimum payment and invest anything that I could pay extra in the stock market. And I've been doing that for a very long time. And you said that you've never met anyone that did that and said they were happy about it. I am that person. I've done that, and I'm delighted with the amount of money I've made in the long run. And my new house, we just bought for about $300,000 US, and I intentionally put 5% down and got PMI to again expect to theoretically in the long run make 8, 9, 10%. Thoughts about buying a house and paying a house off? What do you think? Yeah,
so mathematically that works perfect, right? In a spreadsheet that works perfect.
Yeah, theoretical math.
And historically you use historic numbers which are reasonable for us to assume those numbers will continue in the future, probably not at the same levels, but those are arguments around the edges. So like that's a totally reasonable approach. In fact, it's rational, it's mathematically sound, all of those things. What you would be the first person I've met, but it's too early to call yet. Like we still need another decade.
Yeah.
Right.
Well,
the day
I have a fixed loan, so
either
it's
the day if you could either the day you pull all that money and pay off the house and are like, yep, debt free, and I'm debt free 15 years earlier than I would have been. Like if you behave that way, you will be debt free earlier than you would have been otherwise, right? We both know that. Here's the dilemma. And so if people can behave, amen to that, right? The dilemma is house money, like again in air quotes, money that was mentally accounted for in my house. There's something primal and societal, especially in the United States and elsewhere, but in the United States, we were all taught, like, own your, like, there's the primal area of it that's just like, I want to own my own shelter, right? Like, I want to own it. I don't want anybody to tell me. As people, we've been renting while we've been in New Zealand, and I can tell you, it's not fun, like, it can be awesome. It can be awesome, but there's an element of this where you're just like, dude, I want to own my own space so that nobody else can tell me what to do. So, and then you add to that the cultural thing and the thing that your parents always told you, like, pay off your house, pay off your house, pay off your house. All of that makes a really potent cocktail for misbehavior. So I've seen, here's the perfect way to do this would be, right, do what you do, open an account, and I've done this too with clients that could behave, and we even name the account, like in the nickname of the account, it would say house account, right? Like, ooh, you cannot touch that. You cannot look at, that's your house.
Yeah.
That's just like you're paying down your house. And then what I've seen people do is the market comes along and they are down 20, 30, 40, 50% in that portfolio. And they're like, oh my gosh, that's my house money. And I've seen it's really hard to behave with that house money. So that's the dilemma. And I am sure, when I said I've never met anybody, I'm sure there are people who have done it successfully positive.
Yeah.
I just haven't ever met anybody. And I have been, like, that was the other piece that I said in that wherever you're referring to that, is I almost always say I have been to mortgage payoff parties.
Yeah.
I have been to parties where people are like, we have a big bonfire and they burn the payoff. I mean, they don't burn the actual payoff, but we celebrate by throwing the paid off deed in the fire. You don't actually throw let me just be clear, don't throw the actual paid off deed in the fire. I've never been to a rational portfolio party. Right? I've never been to one. So, but I could see you having a party when you go, hey, look, we could liquidate this anytime.
Well, see, the funny thing is you caught me because I've already reached that point and I didn't have the party. So you should have a party for sure. And then you just think, like, that's at any point, we could pull the trigger over here. What I'm waiting for is the super cool thing would be if you have a 3.5% mortgage, 30-year 3.5% mortgage, and rates on government, basically guaranteed fixed income products get to 6. Then you're in Fat City, right? Like, that would be cool because you could be buying a guaranteed product and you have a guaranteed mortgage. Yeah.
And you're just making the margin.
Yeah, that's really cool. And of course, there may be, for some of my listeners in the United States, the value of doing this may go down a little bit with the new tax laws and your housing interest and or taxes not being deductible or partially or limited, but that's for a whole nother show. once again, everybody, it's Carl Richards. He has 2 books, and he corrected me at the very beginning. The first book, a little bit older, is The Behavior Gap. Does talk about investments, but more about why people think and what they do, and fantastic. And also the 1-page financial plan, both well worth reading. Is there anything we didn't cover that you'd like to dig into? Because I have unlimited time. I know your time is valuable, but any other thoughts?
No, I mean, that piece of empathy. Well, here's the only other thing that is on my kind of list of things that I'm ranting about these days, which is just that we take the time. Like I'm getting increasingly frustrated when it doesn't happen and excited when it does. When people just take the time to hit pause, right, on spending, investing, saving, everything, anything to do with money, just pause for a minute and have a real honest conversation about why you're doing it. Like get some sort of connect. There are plenty of tools out there. There's books that are written about it. Like how do you get? I mean, Simon Sinek's book about Start With Why it would be a really easy one to start with. Like, could you just get connected with like, why are we doing this? Why are we buying unnecessary plastic items? Do we really need? Like, the research is so clear that if the goal is happiness, and maybe even a better word is joy, right? If the goal is joy, the research is so clear it doesn't come from spending, buying, and things. It comes from relationships and experiences. And
I agree.
And so I just wish we would take a little more time to get off that gerbil wheel of and again, this isn't, by the way, I'm not saying stop spending money. Like, it may be that you'd uncover, like, we love eating out. It's like our favorite thing. We go to this great restaurant. We love farm-to-table food, and we love hearing about the stories behind where the meat came from and the vegetables, and like we love eating out. It's a rich experience. We love doing it with another couple, and we want to do that once a week. And amazing, awesome. But you may also uncover, if you just pause a minute and go, look, we don't get that much fulfillment from going to the movies. I'm just picking 2. Like, there's nothing right or wrong about either of these. It may be flipped. You may love the movies, but if you don't love the movies and you're going often because you think you should love the movies, or it's just what you've always done, or whatever, you could take that money and go, cool, let's go out to dinner one more night a week or one more night a month with a couple that we really enjoy and have a deep conversation. And again, back to the coffee. It may be that morning coffee that all of us personal finance people like to hammer you for buying. It may be that morning coffee is like one of the most important moments of your day. If it is, keep doing it, right? But if it's not, maybe there's a different way to get that same experience. So figure out what it is that I think of it as value capture. What is it that you value about the thing you're doing? Take that value and just think through, hey, is there a different way to capture this? I'll give you one last example since you asked. A friend of mine, he has a really good, we went through this exercise, he has a really good friend that he would take to lunch once a month. And his friend is, has had like a decade of tough times, and he and my buddy's wife, my buddy's name is Rob, my buddy Rob and his wife were talking about this. They were looking at their budget. They're like, well, look, you spend $50 a month. They were trying to find every extra dollar to save in the S&P 500. They've been fanatical about this. And they're like, look, you spend $50 a month with this. And they're like, oh, but it's so important, because I can't remember his friend's name. Let's just call him Jimmy. Rob was like, Jimmy really needs me. And so they said, okay, well, what's the value there that $50 is supposedly buying you? Well, it's connection with my friend Jimmy. Oh, okay. Then let's just think about it. It could be that there's no better way to connect with Jimmy than $50 a month at lunch. But what other things do you guys like? You know what? Jimmy loves to hike. I love to hike. We live in the foothills of the Wasatch Mountains in Utah. What if we went on a hike instead? Like, Jimmy can bring a lunch, I'll bring a lunch, we'll go on a hike. Or we don't even have to bring a lunch. Let's meet at 10, go on a hike for an hour. So they've captured the exact same value that they were investing in. And And then on top of it, they put another $50 a month. Immediately, they shifted that $50 a month. They upped their automatic investment in the S&P 500 up $50, and so they've captured both now. And so it wasn't ever about, life of poverty, beat myself up for drinking coffee, or whatever. It wasn't about that. It was about, is there a plus one? Right? Is there both? Is there a way to do both? Right. So I just wish we'd get more clear about that.
Very good. Well, Carl Richards, thank you again for being on the Phil Ferguson Show. I greatly appreciate it.
It was my pleasure. Thank you.
If there is a God, if there is, I think most reasonable people might agree that he's at least incompetent and maybe, just maybe, doesn't give a shit. Doesn't give a shit, which I admire in a person and which would explain a lot of these bad results. So rather than be just another mindless religious robot, mindlessly and aimlessly and blindly believing that all of this is in the hands of some spooky, incompetent father figure who doesn't give a shit, I decided to look around for something else to worship, something I could really count on. And immediately, I thought of the sun. Happened like that. Overnight, I became a sun worshiper. Well, not overnight. You can't see the sun at night. But first thing the next morning, I became a sun worshiper. Several reasons. First of all, I can see the sun. Okay? Yeah. Unlike some other gods I could mention, I can actually see the sun. I'm big on that. If I can see something, I don't know, kind of helps the credibility along, So every day I can see the sun as it gives me everything I need: heat, light, food, flowers in the park, reflections on the lake, an occasional skin cancer. But hey, at least there are no crucifixions, and we're not setting people on fire simply because they don't agree with us. Sun worship is fairly simple. There's no mystery, no miracles, no pageantry, no one asks for money, there are no songs to learn, and we don't have a special building where we all gather once a week to compare clothing. And the best thing about the sun, it never tells me I'm unworthy. Doesn't tell me I'm a bad person who needs to be saved. Hadn't said an unkind word. Treats me fine. So I worship the sun. But I don't pray to the sun. Know why? I wouldn't presume on our friendship. It's not polite. I've often thought people treat God rather rudely, don't you? Asking trillions and trillions of prayers every day, asking and pleading and begging for favors. Do this, give me that, I need a new car, I want a better job. And most of this praying takes place on Sunday, his day off. It's not nice, and it's no way to treat a friend. But people do pray, and they pray for a lot of different things. Your sister needs an operation on her crotch. Your brother was arrested for defecating in a mall. But most of all, you'd really like to fuck that hot little redhead down at the convenience store. The one with the eye patch and the club foot. Huh? Can you pray for that? I think you'd have to. And I say, fine, pray for anything you want. Pray for anything. But what about the divine plan? Remember that? The divine plan. Long time ago, God made a divine plan. Gave it a lot of thought, decided it was a good plan, put it into practice. And for billions and billions of years, the divine plan has been doing just fine. Now you come along and pray for something. Well, suppose the thing you want isn't in God's divine plan. What do you want him to do? Change his plan? Just for you? Doesn't it seem a little arrogant? It's a divine plan. What's the use of being God if every rundown schmuck with a $2 prayer book can come along and fuck up your plan? And here's something else, another problem you might have. Suppose your prayers aren't answered. What do you say? Well, it's God's will. Thy will be done. Fine. But if it's God's will and he's going to do what he wants to anyway, why the fuck bother praying in the first place? Seems like a big waste of time to me. Couldn't you just skip the praying part and go right to his will? It's all very confusing. So to get around a lot of this, I decided to worship the sun. But, as I said, I don't pray to the sun. You know who I pray to? Joe Pesci. Joe Pesci.
You're listening to The Phil Ferguson Show.
All right, everybody, we're going to keep the ending segment here nice and short because I am just too freaking busy, and even this show is out late. So my apologies. If that means something to you, over the next few months, I may start to have more and more difficulty being every single week, but I'm going to try. Anyway, March 17th, I will be in Nashville for the NanoCon convention. And then later in March and into early April, I will be at the American Atheist Convention in Oklahoma City. So I hope to see you there or someplace in the future. Until then, ciao.